If you still use fixed percentage stops, you are letting the market punish you twice. Once when volatility expands, and again when it contracts, and you sit too close to the noise. The average true range adapts your risk to what the market is actually doing right now. In the next few minutes, we will unpack the math, build volatility-based stops and position sizes, and stress test them on real price action. ATR, developed by Wells Wilder, is a pure volatility gauge. It does not care about direction. It answers one question: on average, how much does this instrument move per bar? Wilder smoothed it with a 14-period modified moving average, which behaves like an exponential average with alpha equal to 1/14. That smoothing matters because raw true range is spiky and unusable as a stop input. True range for each bar is the maximum of 3 values: current high minus current low, the absolute value of current high minus prior close, and the absolute value of current low minus prior close. Those last two terms capture overnight gaps, which a simple high minus low would miss. ATR is then the running average of those true ranges. Gaps matter, so ATR matters more on stocks and futures than on 24-hour markets. ATR is expressed in the price units of the instrument. A stock trading at 100 with an ATR of 2 moves about $2 per day on average. To compare across instruments, normalize, divide ATR by price to get a volatility percentage. A rising ATR means expanding ranges, often driven by news, earnings, or a regime shift. A falling ATR means compression, which historically precedes expansion. Watch the slope, not just the level. The classic ATR stop sits a multiple of ATR away from price. For a long position, take entry price minus 2 times ATR. For trailing stops on trends, the Chandelier exit anchors to the highest high since entry and subtracts 3 times ATR. The multiple matters. Tighter values like 1.5 whipsaw, wider values like 4 give the trade room but cost more on losers. Backtest your multiple per instrument and time frame. Here is a synthetic uptrend with a 3 ATR Chandelier trailing stop. Notice the stop only ratchets upward, never down, so as the trend extends, profit is locked in mechanically. Pullbacks inside the volatility envelope are ignored. The exit triggers only when price breaks through the trailing band, which usually coincides with structural trend damage. This is how systematic trend followers stay in moves for months without second-guessing. This is where ATR really earns its keep. Define risk per trade, say 1% of equity. Divide that dollar risk by your stop distance in dollars, which is your ATR multiple times ATR times point value. The result is your position size. Now every trade risks the same dollar amount regardless of whether you are trading a quiet utility or a volatile biotech. Equal risk, not equal share count, is the professional standard. Here is Apple on the daily chart with 14-period ATR in the subpanel. Watch how ATR contracts during quiet consolidations and expands sharply around earnings and macro shocks. A static $2 stop would have been irrelevant in some regimes and suicidal in others. An ATR-based stop adapts, wider during expansion, tighter during compression. That is the entire point. ATR tells you how much, not which way. Pair it with a directional filter. ADX above 25 confirms trend strength worth trailing. A rising 200-period moving average defines the regime. Many systematic traders only take ATR-trailed longs when price is above the moving average and ADX is rising. Without that filter, you trail stops through chop and bleed out by 1,000 small cuts. ATR has real blind spots. It is backward-looking, so a sudden volatility shock blows through stops before ATR catches up. It treats up volatility and down volatility equally, even though crashes typically expand range faster than rallies. And because everyone uses the same multiples on the same lookbacks, clustered ATR stops become liquidity targets that algos love to sweep. Offset your stop slightly beyond the obvious level when feasible. 3 traps. First, using ATR from one time frame to trade another, like a daily ATR stop on a 5-minute scalp. Match the ATR lookback to your holding period. Second, moving your stop after entry because it feels wide. The whole point is to commit to the volatility, not override it. Third, sizing up because ATR is small. Compression is the precondition for expansion, and small ATR often precedes the largest moves. Tomorrow, pull up any chart, add 14-period ATR, and recalculate every open stop as entry -2 ATR for longs or +2 ATR for shorts. Then size each new trade so the dollar distance to that stop equals a fixed fraction of your account. That single change normalizes risk across every instrument you trade. This is education, not financial advice. Test it, journal it, and only then trust it with size. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.